Hi guys, welcome back. Today we're going to move on with our external sources of finance. Last video we were looking at our short-term external sources of finance in the form of debt, and this video we're going to look at our external sources of finance from a debt perspective that are long-term, and they mainly fall under four major categories. They've been a mortgage, a debenture, an unsecured note, and also leasing. I'm going to touch on debentures until the end because I think it's the most tricky of the four. So long-term borrowing, remember short-term borrowing was for those amounts borrowed for up to 12 months. Long-term borrowing is for longer than 12 months or longer than 1 year. So what are our major types of long-term borrowing? Firstly, we've got a mortgage. As I think most people understand, a mortgage is unique in that it is secured to a property. So that might be a commercial property, meaning some sort of office space, or it may be a residential property, house or unit, etc. The reason a mortgage attracts the lowest rate of interest is because it is attached to that collateral, whereas a lot of other sources of debt finance aren't attached to collateral, so that being a property, and therefore they attract a higher rate of interest. The reason being that the lender, with collateral attached to the debt, the lender can access that or even take legal possession of that property should the borrower be unable to repay, and therefore they can go and sell that property to recoup the funds that they have lent in the first place. Whereas things such as unsecured notes don't have collateral attached to them, and therefore they attract a higher rate of interest because of the associated higher level of risk. Okay, an unsecured note. Unsecured note, as the name suggests, means it is not secured to some sort of collateral, to some sort of asset, to something of value. So these are a form of long-term loans for individuals or maybe organisations as well. There's no collateral attached, and there's a greater risk for the lender, therefore there is a higher rate of interest. Thirdly, we've got leasing. Now some people might think, well, why is leasing a form of debt finance? One of the reasons being that, as I'll explain how leasing works, leasing is freeing up capital that can be used for other things, and generally for the long term as well. So leasing is a method of getting access to assets the organisation may require, but doesn't require them to go and purchase those assets. So a good example would be a construction company who might need cranes for the construction of maybe a residential block of units. They don't want to go and buy the cranes that they require. They would rather make a regular monthly repayment for access to those cranes, and then once they've finished building that particular site and they don't need the cranes anymore, they stop making the repayments and they return the cranes to the owner. One of the great advantages of leasing, apart from the fact that it's a tax-deductible expense, is that it frees up capital, and often it can be significant capital that can be used for other purposes within the building, and the business will not have to outlay a significant sum of money in one go. You can imagine that the cost of a crane, if you're buying many of them, you might be looking at outlaying $1, $2, $3 million, whereas you could lease these for a much lower cost. So the last type of long-term borrowing is a debenture. So a debenture is long-term, but it's different that it's not from a bank, but the money is coming from investors. Okay, so with a mortgage, the money is coming from a bank. With an overdraft, in the short-term sort of borrowing, it's coming from a bank. But in this sense, that the money is being borrowed from investors. So these debentures are generally issued by finance companies for a fixed rate of interest and for a fixed period of time. They're generally unsecured, so it's money given by an investor or lent effectively via an investor to a borrower, and there is no collateral attached, and they are unsecured. The investor who has provided the capital, they're getting a regular fixed interest repayment in return for lending this money, and often there is a prospectus required for the issue of these debentures. As it says there, few lenders can offer or are willing to lend all the money needed by the companies. Often the company will need a significant amount of money for potentially purchasing stock or buying some sort of assets. So often many debentures would need to be issued to get enough capital for that company's requirements or the debt requirements. So just to confirm with the debenture, because it is unique, is that the money is coming from investors as opposed to a bank or a financial institution, and that those investors are effectively lending that money to those organisations. It's unsecured, and so therefore there is a higher rate of interest attached. Okay, so they're the types of long-term borrowing that an organisation may engage in, and next video we'll look at equity as a source of external finance.